India's largest asset managers create investors' wealth. Okay, so for this, joining us as moderator will be Mr. Siddhartha Rastogi, the COO and Head of Sales, Ambit Asset Management. Before joining Ambit, Mr. Siddhartha co-founded IIFL Private Wealth and set up a mutual fund and structured product distribution business, IIFL. Prior to that, he has also worked for the HSBC Bank as branch head for the Pedar Road branch, which is the largest wealth branch in India. Siddhartha has also worked for Citibank and UTI Bank in wealth management and corporate banking roles. It gives me a lot of happiness in welcoming Mr. Siddhartha on board. As we get Mr. Siddhartha to join us, I'm quickly going to be introducing our panelists as well. Joining us up front, Mr. R. Srinivasan, Head of Equity, SBI Mutual Funds. Mr. R. Srinivasan joined SBI AMC as a Senior Fund Manager in May 2009. He is now the Head of Equity and also directly manages a number of funds. He has an experience of more than 25 years in equities, having worked with Future Capital Holding, Principal PNB, Oppenheimer and Co., Indo-Suez and Motilal Oswal, among others. Thank you so much, Mr. R. Srinivasan, for joining us today.
Pleasure is mine. Thanks.
Thank you so much. And joining Mr. Srinivasan, Mr. Prateek Agrawal, the business head and CIO of Ask Investment Managers. He is a graduate in engineering from REC Rourkela and a postgraduate diploma holder in management from Xavier's Institute of Management, Bhubaneswar. He has several years of experience relating to finance and equity management. Mr. Prateek joining us. Right. We also have Mr. Siddhartha. Thank you so much, gentlemen, for joining us today. So Mr. Siddhartha is our moderator for the session. I've already introduced two of our wonderful speakers, Mr. Srinivasan and Mr. Prateek. Moving on, joining us, we have two more eminent speakers. Mr. Anup Maheshwari, the joint CEO and CIO of IIFL AMC. Mr. Anup is responsible for the investment and strategy for IIFL AMC's business, including the mutual funds and alternative investment funds. He plays a key role in meeting the company's aggressive growth goals as well as product development and devising an innovative investment strategy. Welcoming on board Mr. Anup Maheshwari as well. And last but not the least, our last panelist joining us, Mr. Prashant Kemka, the founder of White Oak Capital. Founded in the year 2017, June. He is the former CIO and lead portfolio manager of GS India Equity at Goldman Sachs Asset Management from the year March 2007 to March 2017, and also for the Global Emerging Market Equity during June 2013 to March 2017. As lead PM, he managed all the mutual funds and separate accounts under these strategies. So what a wonderful panel we have here today, and what an interesting session it's going to be. So over to Mr. Siddhartha.
Thank you, Shruti. Welcome all the panelists.
Thank you.
Nearly all men can stand adversity. But if you want to test the true character of a man, give him power. These were the famous words said by Abraham Lincoln. The power which is exuded by the leaders, the interminable, the illimitless, the immeasurable power which leaders have. How do they use it? For the benefit of the investor, for the growth of the industry, for the growth of the market participants, or for their selfish motives? So we have four leaders. Srini, who is the leader in the mutual fund business, Mr. Khemka, who's the leader in the overseas business, Anup in AIF, and Prateek in the PMS. Let's hear from them, their journey, their yatra, and their moves, which will determine how the industry will progress. So my first question is to Prashant. Prashant, why outside? Why did you choose global markets? Everybody is talking about India. Everybody thought about India. You came late, but you conquered the outside overseas market. Why? And are there any learnings which budding investment managers can see? Prashant.
Sir, thank you, Siddharth, for the very generous introduction, I would say. In fact, when you were talking about the power to the leader, I was thinking whether you're talking about Trump or about Biden, or were you talking about Modi ji, or whom were you talking about? So thank you so much. In terms of, you're right that bulk of our assets, or more than 80% of our assets, come from outside India, offshore investors. And then that is just to do with my background, my career path that I've taken. I started investing in India very early, in almost childhood time frame, but then went on to study in the US in the mid 90s, and then started working in the US as in global equity funds, both US centric as well as global developed world. For 8 years I worked there, and in the process interacted extensively with clients globally. And then came to India to start asset management business of Goldman, where too, given the organization that Goldman Sachs is, global investment bank and investment management firm, they had very deep reach to investors globally. And as for 10 years as CIO of India as well as of GEM, as you mentioned earlier, I had tremendous interaction with these investors globally, the sovereign wealth funds and the pension plans and the private banks and all those. So it was coming to today, let's say there's 22 years of interaction with global investors compared to more like 4 or 5 years of interaction with India-based investors. And hence there's a greater familiarity amongst global investors about our style of investing, our approach to investing, our philosophy to investing. And that is why I think we've been fortunate to gain their trust quicker, and they've trusted us with their capital. And we are trying to build and replicate the same now in India. With each passing year, we add on to our track record and the familiarity with the domestic client base, and we hope to repeat the same year as well.
So thanks, Prashant. This is very, very important. One thing which you said is when one is setting up the business, one should always look at the core competency where the one has worked, what he or she has delivered in the past, and start working as the starting point and build from there on, rather than jumping the gun and seeing where are the greener pasture lies. Because the world was talking about India and you chose a different path, which was very, very intriguing, and you were successful. So great. My next question is to Srini. Srini, it's actually a dream story of SBIMF. From nowhere, you are today the largest mutual fund in the country. You guys, so the first ETF actually was started way back in 2000 in India. But if anyone has to talk about ETF revolution, it's SBIMF. So tell us about your journey. What went right? How did you conquer this path from nowhere to becoming the best, the leader, and still delivering consistent returns over longer periods of time? Srinivasan, please.
Thanks for your kind words. So we were actually one of the earliest mutual funds here. So we've been around for more than 30 years. So it's not true that we were nowhere. We are, I guess it's a natural progression for us. I think it's taken quite some time for us to become number one. I guess we should have become number one some time back. You are right. I think if you look at our AUMs, we are obviously helped by the fact that SBI is a huge distributor for us. They contribute to almost 1/4 of our AUMs, and we are kind of, we get almost all their business. You were right in saying that we were pioneers in passives. I don't manage passive. Passive is a different segment. But the fact that we identified passive initially and we built out, and that is close to, again, 1/4 of our AUMs, right? It feels good.
Excellent, excellent. So thanks, Srinivasan. So essentially, what you are saying that keep pursuing, and eventually you will become leader. May not be immediately, may not be after few years, but you will become leader if you remain perseverant. So thanks, Srini, for this. Next question to Anup. Anup, you have been a wizard in fund management, and AIF, which generally has been perceived as a tough sell, tough thing to explain to the client, larger ticket size. How IIFL conquered this journey to become the largest AIF manufacturer and distributor in the country. So, Anup, your thoughts on this?
Sure, Siddharth. I really like your adjectives, by the way. It makes us all a lot bigger than we are. And also, I don't know if anyone's told you, but you make a very good news anchor. As the minute you started off, it sort of reminded me of a news anchor. But just to answer your question, listen, my journey on the AI side is a couple of years old. Prior to that, I was a mutual fund guy, like a lot of my fellow colleagues here. In IIFL, I think IIFL has one very natural advantage, which is it deals as a parent entity with high net worth clients with a sophisticated audience. And therefore, the products that have been designed by the firm are also sort of designed across various asset categories that cater to those type of investors. So in the alternate space is a little different from your traditional mutual fund space in the sense that they're multi-asset. So there's listed equities is one element of alternate investment funds. We also have a private equity business, which is largely alternate investment funds. We have a private credit business. So, it's really the aggregate of all of these that add up to it being one of the leading alternate investment fund houses. But to my mind, this is a very early space in India. I mean, alternates are relatively new. It's a big piece overseas internationally as a percentage of global AUM. It's north of 20%. In India, it's still a very, very small entity. So we are a sort of reasonably sized fish in a very small pond at the moment. And I think that will sort of grow through time. So I think there's a lot of potential for this business. All we have to do though is create products that can create alpha for clients. If you can't create alpha, you don't really have a right to exist in this space, especially with a more sophisticated audience who have enough options in front of them. So I think it's all about getting that basics right and then offering the right products that make sense to that audience.
So understood. So basically ensuring that the product mix is right and focusing on that alpha generation in a sustainable manner that help you win in the AIF space. So thanks Anup for the insights. Prateek, over to you. You are so you started later. You were not the first one to enter into the PMS space. It was ICICI Prudential which started way back. But yet, just in 13 years, if I'm not mistaken, in 13 years you have become the market leaders, and by far with a very, very large lead. What worked? What happened in this journey from very humble beginnings? Now you are the market leader. So if you can share some insights, it will be a good entrepreneurial lesson for few of the budding investment managers who are looking to expand. A few things to learn from you, Prateek.
Oh, thanks, Siddharth. I am a professional with ASK. The entrepreneurs are different. In fact, even I was on the mutual fund side, and Anup used to be and on the selling side, like yourselves. When I was on the SBI CAP platform, one floor over where SBI MF used to be in those days, 19th floor and 20th floor. So not only were SBI MF guys friends and now they populate the industry, but on this panel, Anup used to be a huge friend in those days. So I do remember, having taken him around to meet companies and so on in those days. It used to be a 118 any white one, if you remember. That was a luxury car in those days. Actually, coming back to your question, ASK was one of the first acquirers of a PMS license. Okay, but the journey for ASK started when Bharat Shah, who was the CIO at Birla, joined the house when the AUM was like 50-60 crores. in 2001-2, and then we had scaled up to 3,000 crores with Bharat. Came down after the crack in the market post GFC. When I joined in 2011, we had 1,100 crores. Okay, now to give you some part of the background and the learnings, and that may help people who are thinking about a business in this area. First, when I was in ABN, we were house number 14. Okay, we were house number 14. We just had 13 other mutual funds in those days. So when we launched, people received us. We were required by the market. We were like MNC house number 3, if I'm not wrong. So there was a DSP Merrill, there was a Deutsche, HSBC, and us. So there was a positioning, and the market received us very well. Everything you did was a record. I then moved to Bharti AXA. Great brand name, huge distribution. We were house number 43. Okay, you go to the market, the best of friends, best of distribution, de facto said, आप अपना माल हमारे यहाँ रख दो. If the client wants it, we are happy to give. Nobody will push. Which is when जिसको बोलते हैं ना जोर का धक्का धीरे से लगे. That kind of stuff happened. Now, that was a huge learning. You may be anything. You should have a value proposition. You should be the best in what you are doing. You should be able to communicate what you are doing to your target set, reach them. Which is what, when I joined this place happened, took stock, looked at what we were best at. There is one style of investing that the house always talked about, which is high quality, high growth. Who is it best suited for? So what does it result into? A value proposition came out with preservation and growth. It is funny to talk of it, from a mutual fund background, talking of preservation and growth for equity. Okay, we said if this is the value proposition, if this is what we are best at, not one of the best at, if we believe in our minds we are the best at, okay, then let us take it to HNIs. Our audience is not mutual fund guys. Our audience is HNIs who will buy if what we do appeals to them, if they need it, and if we are best at them. So, that's the funnel. So we at least had to be best in our minds at what we were doing. So we did that. We were doing variety of things in the house. We changed all of that, started doing one thing. Okay, second, how do you reach those clients? You don't reach those clients through IFAs. You reach those clients, the guys who have monies, who can understand what you are doing through a distribution channel, who can get you those kind of guys through mostly MNC bank channel. And for that, you need to have structures in place. So mind you, when I joined this place, it was a 15-member team altogether, operations, sales, investment team all put together. And yet we had a risk and a compliance guy who was separate from the team, independent, did not report into me, reported straight into the board. Okay, try hard. That's the next step. Try hard, communicate. It helped that the performance was good while, our philosophy and our manner of investing was, as pure as it can be in the Indian context. We boast of a very high style purity over last 10 years, and that's been our USP as well. That developed over a period of time. And then as luck would have been, gates opened. There was, if I can name them, one of the largest MNC banks who was looking at PMS. PMS, by the way, in 2012-13 kind of a period was not exactly the best of words. But yeah, they opened doors and looked at us. We tick marked everything that they had. We were the smallest global entity, not on a mutual fund platform that they empaneled. Yes, it helped that there was a stroke of luck. That's sure. It helped that after a year and a half, mutual funds who were also upfronting till then were not allowed to upfront anymore, and the MNC houses in particular were also looking at products which could upfront and PMS offered that. So that is point number one. Do everything right, find your niche, be best at it, keep communicating. Someday, it will click. It will take time. We tried from 11 till 14 for it to happen. Second is, when you are small, you can do a lot of things right that you cannot do when you are very large. So, go back to 2011 and even now, mutual funds have zero exit loads. And now, it's a 1% kind of a number that goes to the fund. We said we want long-term investors only. And hence there will be 3-to-1 exit load. It was not dictated by what kind of a fee arrangement I had with any of the distribution. So all of my product, 100% of it had 3-to-1 exit load, one single product. So it helped that, in the marketplace, you can't say, I will give you better terms versus somebody else. No, it is one term. And long-term investors only. Now, when you do that structure and somebody wants an upfront, that was the second stroke of luck. We could do upfront. You can't do upfront if you don't have exit loads. So those things happened. Third was obviously the fact that our style of investing, high quality, high growth, that's easy for people to understand, actually came into focus and sustained for the longest period ever. Since we started investing, 2004 till 2001 was one period, 2002 till 2008 was completely different kind, and 2010 till now, this style, except for 1 or 2 years in between, has held out. So performance sustained. We could communicate how we are going to make you money not over 1 year. In fact, if you look at our pitch book, making money part comes in the end. We first talk of preservation. How do we do it? What happens when the market falls? Frankly, I have seen Hemka's presentation as well. It also talks of a lot of that stuff. And then come down to, the returns and how do we, maintain discipline and all of that. So that is basically how it is. And people have now spent time, at least if you ask our investors, कि जो हमने बोला था वो किया, people will say, हाँ, मतलब जो उन्होंने बोला था वो किया. The outcomes can be whatever. And that is the comfort. Mind you, our guys have made money. 1% difference in return doesn't make them happier or sadder. They don't even want it. Our whole thing is, you have made money, sleep peacefully. You can't be waking up for the returns, right? And when you have full high quality portfolio, when markets are down, we actually get more top-ups. And that helps the guy make more money, versus getting scared when the markets are down. So those are the things which have happened. A lot of things by luck. Luck is a large part of the journey. But I must say, knowing your niche, focused on the niche, we don't try to do multiple stuff. Each one of my competitor knows if he does a mid-cap fund, I will not compete. Let him collect 2,000 crores. I don't want to be there. Okay, we know what we are best at. We want to do what we are best at. The client knows this is why we are buying us. We want to be core of somebody's portfolio. I don't go and ask him for 5% of his money or 10% of his money. I say, I want 50% of your money. So थोड़ा सा हिल जाता है. I mean, some of my listeners would be also wondering कि ये तो प्रतीक नहीं था, change हो गया है. So, that is what it is. And then that gives clients a lot of comfort. And, word of mouth is also now helping. If we have said something, we will do this, we do that. With very few deviations. That inspires confidence.
So thanks. Yeah, thanks, Prateek. So this is very, very helpful. So 4 things, Prateek, you said. One is value proposition, effective communication, and whatever you are saying, stick to it and figure out your target segment and then focus relentlessly on it. So thanks, Prateek, for this insightful talk which you just gave. So next question is to Srinivas. Srinivasan, please tell us, with such large AUMs, and you said that 25% of your AUMs come from the passives, which are totally process oriented, which have just to replicate the benchmarks. What makes you one of the best performing also mutual funds, not only the largest, but one of the best performing mutual funds. So what is the philosophy? How do you ensure that you are consistently there in the top quartile across all funds, whether it is large cap, whether it is mid cap, whether it is contra, all across? So what's the philosophy? How have you been able to do it? Srinivas, your insights, please. Srinivas, I'm sorry, but your mic is on mute.
Yeah, can you hear me now?
Perfect. Thank you.
So it's a long-winded answer. I'll try to be short. Essentially, there are two things that we've done. So we started doing, let's say, 10 years back, and all of that focused around not just performance, but sustainable performance. One thing we did was focus our efforts on higher probability outcome decision making, in the sense that, for example, we don't run these market timing funds. For example, we don't toggle between equity, debt. We haven't been taking those calls yet. So we focused. So let's say you can make money through market timing, you can make money through thematics, or you can make money through stock selection. We believe that stock selection has a higher probability outcome. So the entire team is focused around stock selection, right? Where not only is the impact of that decision higher, but the probability is also higher. Obviously, market timing will have a huge impact, because if you get the timing right, you'll make a lot of money, but the probability outcome is lower. So we focused on stock selection. I think that has helped us. Now, within stock selection, we run a very cliched philosophy. And cliched philosophy is good, because cliched is cliched because it works. We basically try to buy a good business run by good guys at reasonable valuations. All three are equally important. Good business can be defined in terms of economic modes, return on capital, risk of disruption, cash flow generation, etc., etc. Good managements can be cross-referenced primarily through their past track record. And valuations are beyond just price to earnings and price to book multiples. We try to put our thesis into numbers. So the assumptions are different for different stocks based on the thesis, right? So for us, a 50 PE stock can be cheaper than a 15 PE stock. So that framework is something we try to follow as a house. Obviously, because we are mutual funds, we also follow something called a relative return framework, where we basically looking at incremental change, fundamental momentum. We're also looking at upgrade, downgrades. We're looking at relative valuations and a bit of technical momentum. All this is actually built into a quant model, and the analyst is supposed to think in that framework. So we run a combination of these two frameworks, right? So one, focus on stock selection. Within stock selection, these are the two frameworks. And thirdly, and I think most importantly, we've hopefully managed to create a flat structure where the head of equity or the CIO is not more important than the analyst. It's actually the other way around, because we think the analyst is the guy who knows a lot more. So if I buy a stock, for example, where the analyst is negative, I have to break my head and convince him. I can take the decision, of course, but the onus is on me to explain why I bought the stock. That ensures decision making at a level where it is. So basically, we are trying to optimize individual brilliance, we think is important, and process, which means, so we run analyst portfolios, for example. We put our money where our mouth is. We have a 7-year track record in running an analyst portfolio, right? And I think these three things broadly contribute to whatever we've done. And I hope that sustains.
So Srinivas, this is very, very powerful. And the last part which you said is the flat structure, because ultimately those analysts are accountable and they know in depth of the businesses. So this is extremely valuable. And as someone rightly said, it's people who make the processes. And if you follow those processes, the outcome will be brilliant. So thanks Srinivas for this. My next question is to Prashant. Prashant, tell us, you have immense experience and fantastic exposure to the Western world. What do ultimately FIIs like? Because we keep seeing FII numbers. This year FII numbers have been extremely positive. They have been encouraging. Last 3 years, also FIIs have been positive. But there are times when FI seems to be jittery. what do they want? What's your sense? How did you manage to convince them to stay invested with you for longer periods of time? So what's the philosophy? What's the process? Prashant, yes. Prashant, you have to unmute. Yeah, thanks.
Yes. So not just FIIs, but investors everywhere in the world want the same thing: strong performance, or I would say stronger performance. So while people may talk about absolute performance and all that, and there's some relevance of that, but ultimately everyone decides based on relative performance. Okay. In 2017, if a fund manager had given any of us here or any fund manager would have given a 30% return, you would no client would have given you a meeting. In 2018, if you had delivered 3% return, you'll be not having enough time to meet with clients, right? So how can 3% be better than 30%? So there is no such thing as absolute return first and foremost. It's all relative return relative to the peer group. So what FIIs and investors in India or investors anywhere in the world for any asset class, what they are looking for, managers who have over a sustained period of time, long enough period of time, not just last 1 year, 3 years, 5 years, but much longer as well, over this market cycles have delivered top-notch returns compared to the peer group. And that is what makes it very much like analogous. Investing, as I say, is very much like a sport. The absolute level of performance is not what audience comes to and cheers. It's the relative performance that obviously there's an element of absolute as well in any game, but those whether in IPL, we just concluded IPL, the winner is not the team that scores 200 runs or 220. Winner is the one who scores higher. So that is the same logic in investing as well. What clients are looking for is those that can deliver higher return than vast majority of other managers. And then that is same for FIIs as well.
Understood. So basically consistently outperforming the benchmark, and AUMs will be created. Investors would love you and they will flock you. They'll flock you constantly wherever you go. So interesting. Next question to Anu. Anu, you have in AIFs, you have liberty to be close-ended. Hence, you can take longer term bets. And hence, you can actually take businesses without, even if they are volatile in the interim period, multi-baggers. So my question is, how do you identify such businesses? What's the process? What's the philosophy? What's the entire mechanism? How do you identify such businesses which can grow multi-fold?
Sure. So again, the nature of AIFs, like you mentioned correctly, are these tend to be closed-ended type of structure. So in that sense, the capital is a little more under your control. You don't have constant inflows, outflows, and also it's from a tax point of view, it's not very good if you keep activities. In effect, it sort of creates a discipline for you automatically. So that's a nice sort of side effect of AIFs. In terms of how do we outperform, identify companies over a period of time, and that's true for everybody on this panel. I think everybody works with a certain framework. We have our own framework on the listed side, and our framework tries to identify companies that have been able to create sustainable shareholder wealth over long periods of time. I mean, that's in a way, Prashant just mentioned, that's how fund managers are evaluated, and the same logic works for companies, which is, track records tend to have some persistency. There's some element of their underlying economics that creates that trend. So therefore, a lot of our investment framework, it's very detailed, so I won't spend too much time on this forum. But essentially, the idea is
you can spend a little time, Anup, on this because investors will benefit.
Sure. So anyway, so the point is that we have something called an SCDV framework, which looks at the categorized businesses as secular. That's the S. The C stands for cyclical, the D stands for defensives, and the V stands for value traps. And these are basically mapped out, as I mentioned, based on shareholder value creation over a period of time and the underlying business economics. So that's one sort of very quantitative way of trying to identify businesses and isolate your investment universe. And over and above that, obviously, when you're investing for longer periods of time, lower churn type of assets, you want durability and comfort with management as well. So there are these qualitative aspects also that you have to look at, including governance, etc. And I'm sure all of us do that, frankly, in different forms and fashion. But we all come up with our own individual preferences on certain businesses. So so that it's very important to have a process framework and then be very disciplined about it. I think really what we've seen is the more successful long-term investors have that element of discipline and don't try and beat the market in every time zone effectively. So for us, it's that's one element of doing it, but there's a lot more around that. Frankly, it's a bit like how we run our business, which is the first thing to identify is what you don't want to do. It's always easier to work with an exclusion principle. So these are things that we don't want to touch, that limits and makes you focus better. The second is just building a very good culture of transparency, getting the best out of everybody in the team, and sharing that knowledge in a very conscious manner. So there's specific things you have to do. It's not just saying the words, but we literally have a dedicated day in the week where the whole team sits together from 9 to 5 in one room. We have a sort of a knowledge center that we've built. It's a internal secure site where everything that we discuss is stored, and you can cross-reference what you were thinking 6 months ago, 2 years ago, stuff like that. So that sort of culture of transparency and using the best of everybody becomes very important in our business, especially in a people's business like ours. And then, as I said, you've got to put all of that together along with the right process and framework and identify your edges and where you think you're good, where you think you can add value versus where you're not. I mean, you can't add value everywhere. Srini mentioned market timing, is not really everyone's cup of tea. Definitely isn't ours. So I think you've got to then focus on what you think you can add value on. But it's all very process driven. At the end of the day, if you don't have a very clear checklist of what you go through to get something into the portfolio and you haven't thought through it all, the probability of your decision making will not work. I mean, it's all a game of probabilities and trying to reduce the risk of making mistakes. I mean, that's really our job, to just avoid mistakes as much as you can. The outcomes normally tend to follow. I mean, businesses tend to grow over time, not degrow. So as long as you don't make too many mistakes, you will end up adding value.
So thanks Anup for this. So SCBD framework, along with the repository of knowledge, which is on an ongoing basis. So this is something unique which a lot of people can learn, that institutionalization of knowledge which remains in perpetuity. So that's something which our viewers can clearly learn from the experience of yours. So Prateek, my question to you is, you entered into a place where you were the smallest, right? So you talked about that MNC bank which impaneled you. Why did it impanel you? What they found unique about you? And you mentioned that you ticked all their boxes. What were these boxes of theirs, and how did you complement them by getting your product into their product offering suite? So some insights there, Prateek.
No, fair enough. So I go back memory lane, to 2013, early 2013s. Frankly, those were extremely difficult days for us as a house. It had so happened that that was the time when my head of sales and the CEO, then frankly the guy who recruited me over, had both quit, and the team was looking at me, and I would say everybody did more than what they were supposed to do when they were hired. Now, like I said, put in processes in place for getting to the target segment through the distribution that can get you there. We were clear we don't want to go direct, and build in watertight processes. We have, so now it is 10 years. No one distributor can say that any name leaked out from us to any other distributor, for example. So that's the confidence we have in distribution. Second, at the time, getting back to the story, the way you asked it, we were not the largest. So there were 3 other houses on the PMS side who were larger. They were not mutual funds. It helped that that house did not want to look at mutual fund sponsored PMSs. Okay, just to give you some insights, because mutual fund sponsored PMSs have a conflict that they cannot overcome, which is the best managers are on the mutual fund side, and even if a guy on the PMS side is very good, give him chance, he will run over to the mutual fund side. I did that, so there is no exception. I started life as a PMS guy in ABN, 6 months, first chance, and I was on the mutual fund side. So that's a inherent conflict which that platform has. Managers want larger pools of money on every mutual fund which has a PMS. Larger pools are on the mutual fund side. So that house, the distribution house, did not want to look at mutual fund sponsored PMS. This is point number 1. Point number 2, there were 3 other PMS houses which were larger than us in those days. They looked at all of them, each one of them had this proposition of, I will make you more money. You know where I'm getting from. If funds do X percentage return, I will do much more. And when you have that value proposition, the kind of fund that you end up with is a mid-cap, small-cap fund. Now, if you go back to 2008-9 kind of a period, so it is important to understand what were the times at that point in time. If you had adopted a mid-cap, small-cap kind of a strategy and markets fell, in a PMS setting, if a client asks for money back, you cannot sell 4 stocks that you can sell on that day and give the money back, as you can do on a mutual fund platform. You have to sell the entire portfolio. And when stocks are moving down, people could not return money, they return stocks. And a channel faced a lot of backlash from their clients saying, ye kya ho gaya? So that house at that point in time, in the makeup of the mind that was then, did not want to go that way. And our value proposition was not that. We were speaking a different language. Our construct was also not as mid-cap, small-cap even then. And today, if you look at us, we are actually more on the large-cap side than on the mid-cap side. Second, we had got all the processes right. There was an IC with a role. It was not one person do everything. There was an IC with a role. There was an investment team. There was a risk guy who was beyond the investment team and had a very clear risk framework to adhere to. And we could demonstrate that he is independent and report directly to the board, etc., which was a novelty in those days. Now many others may be doing so. But in 2012-13, when we institutionalized this, I had seen it in every MNC. The risk guy never reports into the CIO, probably never reports into the CEO, reports to global this thing. So we had that independence. And that was something which I would say that platform really liked and put us on board. I think that was the start point. In our industry, I think every one of my peer will also say so. Banks make a huge difference, especially MNC banks. If they onboard you, life starts. Otherwise you can keep struggling. When that house empaneled us, I think after that, one after the other, everybody did. It also helped that people who left from that house went to other places, took us with them. What really helped was our manner of pitching. Took the mathematical. It became very, very easy to explain. So practically whole of that channel was selling equity our way. And in the end, if you are selling equity our way, our product was getting sold. So today I should say in that channel, we are the single largest product. There is no mutual fund who has as much money as we have. One single scheme as well. So we are single largest product in various channels that we are on. So that happened, and then from there, the quota kind of Stancy and every other house that we want to onboard. We are not on IFS. That we have opted to not of my UM is from 10 guys. We have a long tail, but that is about it. Very, very focused. We are able to explain anything and everything to the product teams who the graphics, the supporting docs, etc. very well. I think the other thing which worked for us, and that again I should share, that was a huge stroke of luck. Let me do it in a story if I have time. Do I have time? Can I take 2-3 minutes? Okay, so it was like this.
Yeah, go on, Prateek.
This was 2000. Yeah, I thought the link got weak in the interim, but okay. 2013. Times so bad. I shared that, and there was a board meet which was going to happen, and I asked my products guy to tell me how much of performance fees significant we would be profit making versus a loss making house. And we had to eat what we earn. We had no other this thing. And this guy, instead of giving me a number saying we are at 12%, hurdle is at 10%, he gave me a chart. Okay, with that number, of course, but a chart, and a beautiful story came out. So if you look at our performance between 2010 and 2013, you see this, that index is point to point, at the same place. It moves up, moves down, moves up, moves down, but we are able to keep adding alpha. At one point it is 8, then 14. It actually moves up to 41% total versus index, which over this period was 0. And that was something we could showcase. I thought it really caught the eye, and after that, up till it took that house 1 year to put us on board. It sustained and sustained. So September 12 is when we went to that house. September 13 was when they put us on board, and this character of performance sustained. So, and it was very, very differentiated versus, let's say, the funds which were there and their performance at that point in time. So they could position us, and plus the fact that what kind of stocks, if they sell us, etc. And with the two largest for the largest clients, not the retail clients, not the smaller clients. It was only after they experienced positive stuff with the larger client that they open it up with the whole channel. And it happened. Now, there were other things we did. Anything that the distributor asked us, we were small. We did everything. Give us upfront, Lilo, give us trail, Lilo, give us mix, Lilo, do this, do that. Anything that the distributor asked, we did. Okay, systems could not handle it, we did.
Insightful. Sorry to interject. This is really, really insightful. So, how your performance sustained, this is really incredible, and how you cracked with your perseverance, it's really commendable. So, I think we are about the end of the session, and I would want to thank Srinivas, Mr. Khemka, Anup, and Prateek, all of you, for sharing really valuable insights. Just final one word from each of the panelists, just one word to investors, just one word from each four of you, please, sir. Srinivasan, starting with you, please. One word for the investor. Looking at the market scenario, looking at the COVID situation, looking at the underlying economy and global liquidity. Just one word.
One word.
Yes. To the investor.
I guess I'll give you 5 words. Stick to your asset allocation.
Prashant. Prashant, I can't hear you. Can you unmute yourself, please?
Sorry. Always stay invested, never try market timing.
Excellent. So always stay invested, never try market timing. Anu, one word or 5 words? Wisdom.
I'll take the liberty since we're all stretching that a bit. Be patient and be positive.
Wonderful. Be patient and be perseverant. That's what you said?
Positive. Be positive.
Be patient and be positive. Great. Prateek.
Take some profits off the table and spend. Economy needs it.
Good one. Thanks, guys. You guys have been wonderful. Thanks for giving such wisdom, such clarity, and such ideation for the investors as well as for the budding entrepreneurs who want to build their business in investments management. Thanks so much. Thank you, Shri.
Thanks so much. Nice to see all the panelists.